In this video I will demonstrate one of the most, if not the most, complex indicator available when it comes to technical analysis. And this indicator is called the Ichimoku Kinku Hyo. As the name suggests, it's a Japanese indicator. And as it's a Japanese indicator, it's generally best traded with Japanese currencies or stocks and any other Japanese asset. So the indicator looks very complex, but don't worry, I will break down the Ichimoku Kinku Hyo for you, and you'll soon learn how to use the Ichimoku in your trading. So with past indicators, we've had a simple cross like a MACD cross, or we've had a wavy moving average. This indicator has a number of crosses and highlights areas in the market. Why would we use the Ichimoku indicator? The reason being, it can show us a number of things. First, it can show us bullish or bearish bias. It can act as an indicator for trend strength and also potential support and resistance areas. So like I said, this is generally used on Japanese related assets. But as I've used the pound against the dollar in all these videos, I will continue using the pound against the dollar to demonstrate the Ichimoku. So the first line we will look at is this blue line that comes up like this and back down again. This is named the Keygen line, but it also can be called the standard or baseline, and it's generally calculated by using the period of 22 or 26, and it's an average of the highest high and lowest low in the previous 22 or 26 candles. So if we look at this area here, this is the highest high, this would have been the lowest low in the previous candles, and we can see the Keygen or standard or baseline is in the center. It's averaged. So how do we use this first line, this blue line? Well, quite simply, if price is below this line, it can act as an indicator or a signal that price will continue to decline. If price is above this line, it can act as a signal or indicator that price is going to continue to climb. So we can see that price is above our baseline. We have candles closing above this line and price is moving on the upside. When price closes below this line, the baseline, price declines. And you'll notice when we have a cross here, price is bullish. So that's the first line of the Ichimoku explained. The second is this red line, which is called the Tenkan, but also can be called the turning line, and this is calculated by using the highest high and lowest low of the previous 7 or 9 candles, depending on the setting. The way we would use the turning line is an indicator for trend direction or price direction. You'll see that this line is steadily moving on the downside and price is also. Whereas here, the turning line is steadily moving on the upside and prices also. Sometimes the turning line can move in a sideways direction, and that can be used as an indicator that price is ranging. The third line is the lagging line, which is this green line here, the lagging line, which is called the Chiku line. Once again, the setting on the lagging line is normally either 22 or 26, and basically it's the last candle's close 22 or 26 periods back. So you'll notice that our line comes down, moves up, and has this sort of pattern, which is price here. Now, how do we use the lagging line? Well, when price is below the lagging line, price can move on the upside. You'll see we have a cross here, where price is then above the line, and not long after, price goes on the downside. Once again, we have a cross here, and price starts to move on the upside. So if price is closing below the lagging line, price can be bullish. If price is closing above the line, price can be bearish. Then the final part of the Ichimoku is this highlighted area in the market, which is the Senku span, which gives us potential support and resistance areas in the market. The first line, closest to price, acts as the first support or resistance, and the second line acts as a second area of potential support and resistance. The price is downtrending. We have a pullback in the market. We reach the area and we get a pin bar and an engulfing candle, and price moves on the downside. When this downtrend finishes and becomes an uptrend, you'll notice price pulls back to this first support area and is rejected. So that's the Ichimoku Kinko Hyo, and it's not as complex as it first looks.